If you need a home for yourself or for your family, then you need to be thinking with a long time horizon. There's very little upside right now into buying real estate for the short term. But if you're looking to buy with a 3, 5, 10 year plus window, yeah, now is an appropriate time to buy. A couple days ago, we received news that the Greater Toronto Area was experiencing a significant downturn in home prices, particularly in townhomes, semi-detached, and detached properties. That pain has also more recently found its way into Toronto real estate as well, but to a lesser degree. We're going to jump into where those price corrections have taken place, why it's happening, what a price bottom may begin to look like, and if you're a new buyer looking to step into the market, what sort of signals should you be looking for telling you that now is the right time? Now, on top of that, news is being compounded by US Fed announcement from Jerome Powell. The overnight lending rate went up 50 basis points, and we received a little bit more clarity around what the pace of interest rate hikes might look like in the future. On the news, Canadian bonds are rallying hard, which means future lending rates may be higher, and as a result, bond funds are losing value. We need to find out what are appropriate next steps. So I hope I can add a little bit of clarity for you. Let's briefly discuss which areas have been affected most. Now, the areas that have seen the greatest run-up in home prices have also seen the sharpest declines since the February 1st peak. Now, those areas include Brock, which saw around a 29% reduction in price in single-family homes based on detailed reporting from House Sigma. Also, areas like East Gwillimbury have also seen steep corrections of around 20%. Newmarket as well. GTA townhomes overall are down about 22% from their February 1st peak. Condos have declined least at about 6.8%. At the end of the day, people need a place to live, and during periods of volatility like this, they're going to be looking towards the cheapest segment of housing, which are condos. Now, particularly downtown Toronto has shown some real strong resiliency. Sales are still pretty strong, but prices are even stronger, maintaining at or above levels that we saw in February. We're starting to see anecdotal evidence that there are declines in the market, some one-off examples, but aggregated data will come out next month and we'll see how it looks. It's likely that downtown Toronto, midtown Toronto should demonstrate more strength than other areas, considering mass levels of immigration, higher paying jobs that are concentrated within Toronto, and also international students coming in requiring housing as well. Now, when did these corrections start taking place? If we go back to February, there was a couple events that really accelerated borrowing costs. Now, from my point of view, borrowing costs are tied directly to prices. At the end of the day, when 5-year bond yields, which are an indication of where short-term borrowing rates are going, they started spiking around February. And those events were as a result of higher than forecasted consumer price index readings. First one came in January, then February, March, and April's reading is expected to be substantially higher as well. Now, those events were also compounded by Russia's war against Ukraine, economic lockdowns in Shanghai as a result of COVID-19. The combination of those events has exacerbated perceptions of supply chain challenges that have led to the inflation we're seeing. So with very recent easing of those restrictions in China, in all likelihood, we're going to be seeing higher inflation readings for a few more months to come at least. Best case scenario is that we've seen peak inflation, but I would say it's less than likely. With that said, since January, the US Fed and the Canadian Fed have decided to take a far more aggressive path towards hiking interest rates and have signaled as much. So we've already seen 75 basis points of interest rate hikes. We're expecting to see another 50 basis points coming in June, and in all likelihood, another 50 basis points to follow after that. That'll take the overnight lending rate from 1%, where it's currently sitting, to 2%. Some forecasters have the overnight lending rate getting to 2.5% to 3% before the end of the year, although there's no consensus on that. The US Fed Chairman Jerome Powell also came out and said anything above 50 basis points is not on the table and hasn't been discussed. So we can have a pretty material amount of confidence that in Canada we won't see higher than 50 basis points at any particular meeting either, considering our inflation readings have been lower than in the US. Now, you might be wondering, what is the exact impact of raising future borrowing costs for anybody looking to purchase a home? Well, in Canada, we've got something called the stress test. So all mortgages have been qualified at a much higher posted rate. So if you took a mortgage at a rate of 2.99%, the bank was still approving you based on a qualifying payment at a rate of, once upon a time, 4.79 and more recently 5.25. Well, since January, as the 5-year fixed rate crept above 3.25, the qualifying rate on a 5-year fixed mortgage also started to climb. Today, the qualifying payment on a 5-year fixed mortgage is somewhere closer to 6.25%. That means that compared to where we were back in our peaks in February, somebody looking to purchase a home has about 12% less borrowing capacity than they did at that time. Simultaneously, their borrowing rates have also climbed from somewhere around 2.99 or the low threes to now about 4.25. So borrowing rates have increased roughly 30% over that period as well. And if somebody was looking to buy back in 2020, borrowing costs have risen at least 2% since that time. So between the roughly 1.5% to 2% rise in borrowing costs and the higher qualifying rate as well, there's a lot of downward pressure on prices. Let's be specific. If somebody was taking a mortgage at 2.99% about a year ago, and today they're taking it at about 4.25%, their borrowing costs on a 5-year mortgage term, that is the amount of interest that they're going to pay over the duration of the term, has increased 43%. Now, even when we consider the fact that in recent months, home prices have fallen around 20% in certain areas, it would take a smaller mortgage as a result of a lower purchase price, but with the higher borrowing cost, you're still paying about 20% more in total interest expense compared to the February peak. Now, in my line of work, I often get asked the question, and increasingly so, what is the price bottom? When is an appropriate time to buy? And I think that's a really important conversation to have. I like to classify potential buyers into 2 categories. End users, that would be somebody who intends to use the home to live in as their own owner-occupied property, maybe just for themselves or them and their family. And the second would be an investor. And the rationale for each of those parties buying a home is quite different from one another. If you need a home for yourself or for your family, then you need to be thinking with a long time horizon. There's very little upside right now into buying real estate for the short term. But if you're looking to buy with a 3, 5, 10 year plus window, now is an appropriate time to buy. We're already seeing a softness in the market. And even if we're not at a market bottom, the reason why you may consider buying now is because you're going to have a greater selection of inventory to choose from. You're also going to have a less competitive market environment. If you require certain financing contingencies, inspection contingencies, you likely have the flexibility to do that when you go out shopping for a property. With more inventory, you'll be able to be more selective to find an ideal floor plan for your family. So trying to identify a price bottom is a fool's errand, whether it be in real estate prices or any other asset class. You need to take the opportunity to do what's best for yourself, for your family, and find appropriate shelter. Now, if you're an investor, the circumstance is a little bit different. The numbers need to justify you moving ahead right now. And if they don't, then you need to identify what a price bottom would look like. Now, there are going to be certain micro and macro factors that help understand whether or not we're approaching a bottom, and they could be somewhat of an indicator for you in making that decision. Again, not big on speculating on the short term, but these are some of the things that I personally look at to try to identify when I should be taking some of my cash allocation and maybe putting it back into the market. So some of the important factors I'm looking at today are CPI, Consumer Price Index. What is the cost of consumer goods on a month-over-month basis and on a year-over-year basis? Another one is Producer Price Index. What is the cost for the manufacturers to produce the goods that I'm buying? If their costs are rising on a consistent basis, they're most certainly going to pass those costs on to consumers as well. You also want to have a look at things like GDP. What are the GDP readings? Is the economy in an expansionary phase, or is it contracting? Is it contracting in consecutive quarters? And what might these various factors mean for the future path of interest rate hikes? Ultimately, it's fair to say that interest rates have proven to be the largest driver of price movements historically and more recently. After we had a hike in borrowing costs, the market turned over almost immediately. I'm going to be looking at what's taking place on a macro level around the world. Some of the things we talked about. Again, the war in Ukraine, the lockdowns in China, they're going to give us some idea of when we might see peak inflation and a restoration to a more accommodating policy from the Bank of Canada. So those are some of the things I'm looking for to establish a price bottom. If you like this content, please hit the like, please hit subscribe. It really helps with the algorithm and getting this information out to more people. I would certainly appreciate it.